Greetings from Fin Study Club. My name is Ankur Kulshrestha, welcoming all viewers to a session on fair value model, which is applied for accounting of investment property, which is a part of reading 30 long-lived assets of your curriculum level 1 financial reporting and analysis. Now, before looking at this video, it is absolutely imperative that we have already done some basics of long-lived assets, number one. Number two, we are familiar with concepts like depreciation, and number three, we are aware that there are two rules that you'll have to do for the curriculum, which is IFRS and the US GAAP. Once you have this backdrop, with that, I am absolutely good to start with the meaning and the accounting aspects for something known as investment property. Now, you are aware that your long-lived assets are generally the assets which are held for use by the company. What I'm trying to say is, let's take any example called Apple. Apple has a big server attached into their IT room. Server is like an asset which is going to give them benefit for more than a year, therefore it becomes a long-lived asset. My question is, the purpose by which Apple has purchased this server is not to make money by selling it. They are not considering the server as inventory. This is perhaps the model of the producer or the supplier from which they have purchased the server. So short point is, Apple is holding this long-lived asset for using in the business so that they can generate a lot of revenue from the operating activity later upon. It is absolutely similar to say that General Motors has got huge plant where there are a lot of robots, in the generation and manufacturing of cars. Now, the objective by which General Motors is holding these is not that they want to make money by selling these robots as such. They are holding them for using so that they can be helpful in production of cars, and the money is generated by selling the cars. So long-lived assets are generally held for use. But here is something which is a long-lived asset, which is either land or building mostly, and the objective of ownership is neither to hold it for use, nor it is to make money by selling it on a day-to-day basis as an inventory. So basically I'm saying investment property is neither held for use nor it is held as inventory. It is the third objective, which is non-operating income. What I mean by that, if let's say Apple has got its main income from let's say selling iPhones or iPads or iPods, the objective by which they are holding a piece of land in, let's say, Los Angeles is to enjoy the capital appreciation, and perhaps whenever time is good, they're going to sell it and make some capital gains. I understand by doing that, Apple will not become a real estate company, and therefore this property, which will be held for investment purpose, is known as investment property. So let's just see what the slide has to say. It says there is a separate category, not one, not two, not held for use, neither held as inventory. So there is a separate category which is the property, as in land and building, purchased by the business for the purpose of earning A, rentals, and capital appreciation. This concept is very, very similar to the passive investments that we have done in the reading balance sheet, wherein held till maturity, available for sale, and trading. The objective with which the business invests is not to actively participate in the management, but to passively earn some returns. So again, there the keyword was passive. Here as well the keyword is passive. I am not becoming a real estate company by actively buying and selling properties like this. What is also very, very critical to understand from exam point of view, that there is the concept of investment property only under IFRS. US GAAP, absolutely no such concept. which means that any kind of property held for use or held as investment will have to be accounted for using a same model. Whereas in this case you have a choice. Either you can use your cost model, which is measuring the asset at historical cost, then reducing the value through depreciation, or the fair value method. This is what is forming the gist of this particular short reading. Let's just try and understand what is the fair value model or method. Before getting on to that, I want all the students to understand what is an accounting model all about per se. An accounting model basically will have some rules of presentation in the balance sheet and income statement and the resultant cash flows to be shown in a particular manner. So the way it is represented in the financial statement, all those are put together and called as an accounting model. My fair value model is fairly simple, which says that any balance sheet valuation needs to be done at fair price, which means to say mark to market, pretty much like derivatives, and any change in the value from the previously recorded needs to be taken to the income statement. Important point, there is no rule of OCI that comes into picture. So if I have to make and tally a magical equation, A is equal to L plus C, any change in the value of the asset will be directly impacting my P&L account. I will tell you why this model is not a very prevalent model after looking at this example. Let's say a building was purchased by Apple for $10 million on 1st July 2012, neither for the purpose of immediate sale, which means they are not holding it as inventory, nor for the purpose of using it for business. That means neither it is being held for use, but for the purpose of earning some rental incomes, which is like a non-operating income. Its market value on different dates were, so these are like the given market values. We need to calculate the impact on the financial statement if Apple choose to follow fair value model. Of course, you would remember from the previous page that the company has a choice. There is no compulsion even under IFRS. So I'm going to make this statement one by one. It's hardly going to take me 10 seconds per year. A is equal to L plus C is what I will every time follow, and I want all the students to kind of pay attention to this point, that on 1st of July my cash will go down to the extent of 10 million, and the same is the value of the property, which will go up on 1st of July. So that's basically the mother transaction for the purchase. Let's talk about the 31st December. Let's talk about what happens on the balance sheet date. So on 31st of December, my asset was marked to market at 11 million, which means an increase of 1 million. This is obviously an unrealized gain because I haven't sold the building as yet, but my fair value model says any kind of gain, realized or unrealized, will go to the income statement. So my income statement go up by 1 million. So every time the valuation is done at mark to market, and my gain goes to the income statement, no OCI. On 31st December 2013, my assets will go up by 0.75, and similar is the gain in the income statement. So that's fairly simple. On 31st December 14, you would see that there is a considerable fall in the value. So I am going to drop the value by 2.75 to make it 9, and your entire loss, without thinking too much, will go to income statement. Fairly straightforward and simple is this model, wherein any kind of change will go to your P&L or income statement. Let's talk about what happens when the prices again go up. But I think in 15 the prices are going down by further 0.25, and again 0.25 goes to the P&L. So this magical equation is basically tells you that your comprehensiveness and accurateness of the accounting is there. In 2016, the last year in the example, the value goes up by 3.25. Without thinking too much, it should go to P&L. So it is fairly simple model wherein we talk about taking any kind of gain, realized or unrealized, to the income statement. Now I have the similar question but using historical cost model, and it is given that the life of the building is 20 years. Now in such a case, the mother transaction where cash goes down by 10 and building or the property goes up by 10 is going to remain same. Anyways, that's the transaction for purchase. Hardly will be there be any change, but the changes will start to happen on 31st of December onwards. So if my life is 20 years and the total value of the building is 10, so I would assume straight line method, as per which the depreciation will be the historical cost minus salvage, not given in the question, divided by the life, which means 10 upon 20, $0.5 million is the per year depreciation. Now taking this figure of 0.5 per annum, you would have to see that in the first year it is only for 6 months, so the value of assets go down by 0.25, and that is the fall in the expense, because the depreciation goes up, the profit comes down, so is the capital. So my capital, now the profit, comes down by 0.25. This is what happens on year end 12. Let's talk about what happens on year end 13. Your assets will go down by 0.5 every year, and the same is the depreciation that will be charged in the income statement. Point to be noted, under the historical cost method, you are not allowed to upward revalue your assets. It is not allowed. Okay, so you would see that there is absolutely a stark difference between the historical cost model, wherein the value keeps on falling because of the depreciation and sometimes because of a surprise impairment, but there is never an increase. However, my fair value model is absolutely, so to speak, indefinite, a non-dependable model, because the value of the asset can be increased to infinite, and the worst aspect is that you can transfer the asset into your P&L, which is impacting your performance. So in case a company wants to fraudulently manipulate its income statement, they can choose to follow the fair value model for some of the properties which are doing good, and they can charge all that profit in the PAT to show their brilliant performance. That is perhaps the reason why not many companies prefer to follow the fair value model, it being a little kind of perceived as fraudulent. So I hope that the current session on investment properties and the fair value model was useful. You need to subscribe to our channel on YouTube for regular updates on videos that we are recording for different modules of CFA level 1 and 2. Should you have any query in relation to any of the videos, any questions, any more topics that you would like us to take, any specific points, we'd be very happy to receive your feedback, doubt, query, questions on finstudyclub@gmail.com. We look forward to speak to you in my next session. Signing off right now. Thank you very much. This was Ankur Kulshrestha from FinStudy Club.